Good day, doctor. My name is Lim Zi Xin with matric number 293975, and now I'm going to present my individual assignment, the determinants of credit risk of Riyadh Bank in Saudi Arabia. The bank was established in 1987 on the headquarters in Riyadh, Saudi Arabia. The bank has provided comprehensive banking service such as the corporate, retail, investment, and the Sharia compliance. The product and services that the bank provided include the personal loan, the mortgage, credit card, SME financing, and the treasury service, while the digital service that through the online platform and the mobile apps has also been provided. For the problem statement, the credit risk still remains a significant issue to the financial institution as it will affect the bank profitability and the operation sustainability. In this study, there has some problem that's faced by the Riyadh Bank, which the first one is the risk of borrower default, as the non-performing loans still remain a concern that can directly impact the bank's profitability and the financial stability. The second is the economic uncertainty, such as the shift in the market condition that will affect the quality of the bank assets and the performance of its loan portfolio. The third is the strong regulatory pressures from the Saudi Central Bank, which requires the continual updates and improvement to credit risk assessment module to meet evolving standards. And lastly, the external factors like the oil price volatility and the inflation also play a critical role, especially in Saudi Arabia as an oil-dependent economy. As highlighted by the Changrun and Messi 2025 and the Al-Shamasi in 2025, these economic variables can significantly influence the overall credit risk exposure to the bank. There are three research objectives in this study, which the first one is to determine the impact of internal factors on the credit risk of Riyadh Bank. The second is to determine the impact of external factors on the credit risk of Riyadh Bank. And the third one is to determine the impact of internal and external factors on credit risk of the Riyadh Bank. For the research questions, the first one is, does the impact of internal factors on the credit risk of Riyadh Bank? The second, does the impact of external factors on the credit risk on Riyadh Bank? And the third one is, does the impact of internal and external factors on the credit risk of Riyadh Bank? For the literature review, I will only cover for three variables in these presentations, which are the credit risk, the leverage, and the M2 money supply. According to Charlotte and Abu, credit risk is the possibility that a borrower cannot repay the loans either partially or fully at the maturity. Credit risk can measure using the non-performing ratio, and the higher credit risk can lead to the financial losses and reduce the bank profitability. Besides, the leverage shows the proportions of assets financed through the debts. The higher leverage increases the financial risk and the interest expenses according to the BWRRK3073 in 2022. The M2 money supply is the broad measures of a country's money stock with M1 plus saving deposits, time deposits, and the money market funds according to the Margeveder and Moroza in 2022. The axis M2 growth may lose the lending standard and increasing the potential higher credit risk through the higher default probability. In the methodology, the internal factors data was collected through the Riyadh Bank annual report, while the external factors data was collected from the economic indicators on the internet. The DV for this study is the credit risk, while the IV for this study was categorized into three models, which the first model is the impact of internal factors on credit risk. The second model is the impact of external factors on credit risk, while the third model is the impact of both internal and external factors on the credit risk. The SPSS strategy is used to acquire the result of the three models. The outcome will be seen in the following chapter 4 are the descriptive statistics, Pearson R correlations, p-value test, model summary, ANOVA, and the coefficient analysis. For the descriptive analysis, the credit risk of Riyadh Bank with a mean of 0.0119 and the standard deviations of 0.0041. The low mean and standard deviation indicate that the Riyadh Bank maintained a stable and controlled credit risk level with minimum fluctuations across the observed period. For the internal factors, the leverage with the mean of 0.0832 and the standard deviations of 0.051 indicate that the bank relies moderately on debt financing with some variability across the year. For the external variables, the GDP growth rate ranged 2.36%, but with a higher standard deviation of 3.18%, showing that the Saudi economy experienced fluctuating across the study period. This economic shift would potentially impact the bank credit risk exposures indirectly. The table below has shows the correlation analysis of the variable. Based on the data, the leverage with the p-value less than 0.001 and shows the most significant and positive correlated with the credit risk, while the risk-weight assets ratio RWA with the p-value equal to 0.002 represent the strong significance and negative correlated with the credit risk. And for the module summary, the first module has the adjusted R-square with 0.929, shows that the module 1 can explain 92.9% of the variance in credit risk, while the module 2 has the adjusted R-square with negative 0.926, shows that the module 2 are able to explain 92.6% of the variance in credit risk. While for the last module, module 3 has the adjusted R-square of 0.994, shows that module 3 is able to explain 99.4% of the variance in credit risk. For the ANOVA test, only the module 1 and module 3 shows the significance with credit risk. For module 1, the p-value at 0.045 indicate that the whole regression module is only marginally significant to credit risk, while the ANOVA test for module 3 with the p-value in 0.057 indicate also the overall regression module for module 3 is only marginally significant to credit risk. However, for module 2, the p-value in 0.858 shows that the overall regression modules for module 2 is not significant with credit risk. Next is the coefficient analysis. In this analysis, the leverage shows the most significant positive relationship with the credit risk. In module 1, the beta value of leverage is 0.771 and the p-value equal to 0.066 shows the marginally positive relationship with credit risk, while in module 3, the leverage with beta value equal to 0.800, p-value equal to 0.038 shows the leverage has the positive significance to credit risk. This means that the higher leverage ratio will increase the credit risk in Riyadh Bank. Besides, they have also another predictor shows the significance with credit risk. For example, in module 1, the RWA and the loan with the negative beta value and the p-value nearly to 0.01 shows a weak negative association with credit risk. In module 3, the market risk has the beta value of 0.625 and the p-value equals to 0.078, shows that the market risk is moderately positive significance to credit risk. For the external factors, the yield curve and the M2 money supply with the negative beta value and the p-value nearly to 0.05 shows the two factors is moderately negative significance to credit risk. However, for the module 2, as all of the p-value of all predictors greater than 0.10 shows that none of the predictors are significant to credit risk. In conclusions, the leverage is the most significant factors that impact the credit risk in Riyadh Bank. The regression analysis also confirmed that the higher leverage will increase the bank's credit risk. This is identical to the findings of previous study of Lee in 2022. Even the leverage can amplify the profits to banks, but the increase in leverage will also increase the obligations for Riyadh Bank to meet the debt repayment. This will increase the credit risk exposures to Riyadh banks, especially during the economic downtimes or the market volatility. Then, among the module tests, the module 3 that can explain 99.4% of the variations in the credit risk shows the best performance among the 3 modules. Based on the findings, there is 2 recommendations for the Reserve Bank, which the first one, Reserve Bank should strengthen its leverage monitoring by setting a clear internal limit on acceptable leverage level. This should be regularly reviewed and adjusted in response to market conditions and the regulatory change. This proactive approach can reduce the bank exposures to credit risk and improve its ability to withstand the financial shock during the economic uncertainty. Furthermore, the Reserve Bank should enhance its lending policy by implementing stricter credit evaluations and loan assessment procedure. More rigorous assessments of borrower creditworthiness will prevent the excessive loan approval that will lead to an increased leverage ratio and the potential loan default. By tightening the lending standard, the bank can maintain a higher loan portfolio and reduce the occurrence of non-performing loans, which will in turn to contribute to the sustainable profitability and lower the credit risk exposures to the Reserve Bank. That's all from me. Thank you.